welcome everyone. It's the Wealthy Accountant back for part 2 of the 5-part series that Rachel Miller asked me to do on wealth building and personal wealth. Today we're going to be on Tax 101, the second of 5 lightning round of tax tips. So what I want you to do is come along. This is going to go at a very rapid pace. I'm going to put a lot of ideas out there for you, the ones that are most common that come up when I do interviews online and with in other places for other people. So what I want you to do is take notes, and you can actually go back and review this as well. So come along, let's go to another spot. Okay guys, the tax code is huge, and this isn't even all of it. This is just the laws that were in existence a few years back and some of the regulations. There's a lot more. There's the CARES Act and the Secure Act and the Tax Cuts and Jobs Act of 2017. But what we want to do is we want to get some of the really easy to use tax tips that you can use to cut your taxes immediately and, if at all possible, reduce the record keeping time that you spend. So first thing, travel. Business travel is the number one thing that comes up. It's the biggest pain that business owners have. You have a side hustle, a small business, and what do you have to do? You got to get all these little receipts. You got to keep track of everything. You got meal expense and miscellaneous expenses and the hotel expense and travel, the airline and things like that. It's actually simpler than that, folks. Any bill you have when you are on a business trip doesn't need a receipt if it's under $75. You heard that correctly. If it's a meal expense, not necessary. If the meal plus tip does not equal $75, if it's like a newspaper or a cup of coffee, things like that, don't need the receipt. The only thing you're going to need a receipt for, no matter what the cost is, even if it's under $75, is lodging. So that's step number one. When you're on your business trip, there's another way to do things, for example, too. Meals, for example. Meals are, of course, if it's under $75, but you can actually use a per diem. You can actually go to a chart. I'm going to have a listing for you, a euro below in this video. What I want you to do is you can look at that and you can actually pick the actual per diem for the city or a high-low rate. Why is that important? You don't have to keep receipts again, and here's the really neat thing. If the per diem is more than what you're actually expending, go ahead and take the per diem. That means you get a deduction for money you never spent. The next thing a lot of the small business owners have is an office in the home. And an office in the home also gives you 2 ways to do things. The first way you can do it is actual expense again. Keep track of all your expenses, your mortgage interest, your property taxes, your utility bills, the insurance, any repairs and maintenance, and you add them up and then you take the pro rata share of the amount of your house that's a business. That is the office in the home. So if you have a 3,000 square foot house and you have a 300 square foot office, 10% of all those expenses become deductible on that Form 8829 and flows through to your Schedule C, or it could be as a reimbursement under an accountable plan if you have a S corporation or a partnership. Here's the really neat thing about this. You can actually do a per diem, and you can even use some double dipping here. And here's how it works. You're allowed to take $5 per square foot up to 300 square feet as a deduction, as a safe harbor each year. That's $1,500 maximum. So again, our example, 300 square feet of the house is going to be your office in the home. That's a $1,500 deduction. All the expenses that go on Schedule A, like mortgage interest and property taxes, still go in the same spot. You don't have to prorate any of those things out. That could be a double dip. Now keep in mind, you can flip that on its head. The SALT tax, remember that SALT deduction that's limited to $10,000, those state and local taxes? That office in the home now might not be that good of a deal if you put things back in Schedule A, so now you might want to actually pull those things as actual expense. So your facts and circumstances will determine what path you take, but again, a nice way to take an extra deduction. And deducting your miles on your vehicle, you have the ability one time to move to actual expense. So keep in mind, with taxes, if you're in mileage, you can move to actual expense. If you're in actual expense, you have to stay there. But here's where it's kind of interesting. That mileage rate actually has components inside of it. Some is for gas, some is for oil changes, some is for repairs, some is for insurance. What happens is there's also a component for depreciation. You add up all those business miles, add up the depreciation portion, subtract it from your vehicle. You can now convert that vehicle to actual expense. Why is that important? Well, here's where it would come into play. Let's say you have a really nice vehicle you love to use, you don't want to get rid of it. the mileage rate is not going to be the best deal because this year you're going to have a major expense in that vehicle. You then can convert that into an actual expense vehicle. You can then take that big deduction from that repair expense. Of course, you have to stay with the actual expense, but it can be beneficial to you. So you have to look at your facts and circumstances. Certainly a way to save some money.